Joining me now is Paul McCulley, former chief economist at PIMCO, currently an adjunct professor at Georgetown's McDonough School of Business. So, Paul, this hasn't shaped up exactly like you thought it would, say, 3-ish months ago, because, yeah, they're looking at possibly 2 hikes. They're not done, and yet things sort of seem to be working out. So what's Powell going to potentially say, one side or the other, that's going to affect the markets after tomorrow?
Yeah, I think the markets have been in line with a more positive outlook, a soft landing outlook. So the markets have been there, but the Fed does not want to declare victory. That is the bottom line. They paused at the last meeting, but they put 2 more hikes into the projections for end of year. So the bottom line is the economy is doing better. Disinflation is happening. Soft landing is coming into vision. All of that is good news, but the Fed's not going to declare victory until it sees the whites of the eyes of a weaker labor market. It hasn't seen that yet, so I think they will tighten, obviously, tomorrow. And I think Chair Powell will reiterate that the projections have another hike before the end of the year, and that he thinks it's still likely unless the data come in on a positive surprise, both on inflation and softer labor. So we're almost there, but we're not there, and he ain't going to declare victory early. He's going to declare victory late.
Steve Leisman, getting back to the conversation that we were just having about what's the Fed to do, and Paul was mentioning they're not declaring victory. They can't, right? Because inflation has been relatively, core inflation, stubborn.
Yeah. I think I heard a sound of a large exhale around noon, and it came from the Federal Reserve, John, when UPS signed that contract with the Teamsters. I think they're very happy about that was done and does not seem to have been done over the top. I'm also really interested in what Rick was reporting, and I want to engage Mr. McCulley on this, John, which is what you don't want to be, I think, is an institutional bond investor and look back on the possibility that the Fed is at or near the end of its hiking cycle, and you missed a big, juicy 4.17% possibility of a yield on that 5-year. At some point, those long-end yields will start to look good if indeed there's a sense that the Fed is done here, with the question and the proviso is whether or not somehow that curve reinverts, but perhaps it pivots along the long end and comes down. And, John, just for the investors at home, what I'm really asking about is this the time to think about locking in some rates because perhaps the long end is done? Yeah,
and just to add a little to that before, Paul, you jump in, I mean, everybody's feeling really good about what they're getting on savings right now, but that's going to fluctuate when rates come down. So if you lock in, you don't have to worry about that. Paul?
I think there's a lot of merit in moving into the belly of the curve, which would be the 3, 5, 7 area of the curve. Not so much the longer end of the curve, but yes, I think now is the time that, if I was still managing portfolios for other people's money, I would want to be at least neutral of duration versus the benchmark, and I would want to be in the belly of the curve in anticipation that the Fed's going to stop. And then looking out into 24, that as the economy soft lands and jobs slow down and so forth, then we actually will get an easing and a resloping of the curve. And in fact, I think that's the most exciting and interesting thing to talk about looking out to 24 is the Fed itself is forecasting easing, not this year, but next year. And right now they're in the end game for the tightening process. But soon, perhaps this fall, perhaps at Jackson Hole, the Fed will have to start talking about the easing process for 24.
Let me ask another one for the folks at home. What about some of these bond funds out there where the yields are pretty good? There's not an inordinate amount of risk in some of these, but people are feeling a little bit spooked based on what happened in 2022. The prices came way down. The flip side of that is the yields are now up, but there's been such a bias toward equities for years that they might be staying away. Similar situation where that's a way for the folks at home to perhaps play this and kind of rebalance their portfolios?
Well, it gets down to the whole issue for folks at home, the equity versus fixed income. But as you get older, you're more focused towards fixed income. And obviously, a lot of people got surprised last year that actually bond prices go down when interest rates go up. So they got to see that red ink on their statements. But from this perspective, you know, in the 4 to 5 range for the belly of the curve, then I think it's a good opportunity to lock in those yields. And if you can, try to have, you know, the memory of what happened last year with respect to the prices of your funds be in the rearview mirror. But I know it's hard. It's probably the biggest question I get asked when I'm out and about here is, you know, what happened to my bond portfolio? Interest rates went up, bottom line. Now they're up. You need to buy some bonds.
All right. You heard it here. We didn't shy away from the bond story. Paul, Steve, thank you.